In 2021, leaked IRS data revealed that Elon Musk, Jeff Bezos, and Warren Buffett paid a true tax rate of less than 4%. Meanwhile, the average nurse, firefighter, or software engineer pays 24% or more. You have been taught to believe this is because they are cheating. You are wrong. They are simply playing a game called buy, borrow, die, which exploits the difference between income and wealth. Today, I am going to break down the exact three-step system the ultra-wealthy use to delete their tax bills. And then I'm going to give you the normal person blueprint to protect your own money from the IRS. It feels illegal, but it's not. There is a specific reason why a school teacher pays a higher tax rate than a billionaire. It's not because the billionaire is hiding money in a suitcase in the Cayman Islands. It's because they are playing a completely different game with a different rulebook. Most people operate under Rulebook 1, the Employee Rulebook. In this world, you trade your time for money. You clock in, you do the work, and you get paid. But here is the problem. The IRS taxes earned income more aggressively than any other type of money. Before that money even hits your bank account, the federal government takes a cut, the state takes a cut, and FICA takes a cut. You are trying to build wealth with what is left over, which is like trying to fill a bucket that has 3 holes drilled in the bottom. The wealthy operate under Rulebook 2, the Owner Rulebook. They understand that the tax code is designed to incentivize ownership, not labor. They don't want a salary. In fact, many CEOs famously take a salary of $1 per year. Why? Because a salary is a tax trap. Instead, they want assets. They want things that grow in value: stocks, real estate, businesses, because the tax code treats growth very differently than it treats wages. Today, we are going to break down the strategy known as buy, borrow, die. It was coined by a law professor named Edward McCaffrey, and it is the standard operating procedure for the top 0.1%. By the end of this video, you will understand exactly how they legally opt out of the tax system, and how you can use the same principles to shield your own retirement. Let's start with Phase 1, buy. The strategy starts with a simple premise. You cannot be taxed on money you haven't technically made yet. In the world of the wealthy, there is a massive difference between realized gains and unrealized gains. Let's say you buy a share of Amazon for $100. 10 years later, that single share is worth $1,000. You have become $900 richer. That is a mathematical fact. But does the IRS send you a bill for that $900 profit? Number. As long as you do not sell that share, that wealth is invisible to the tax collector. It sits in your account, compounding year after year, completely tax-free. Compare this to a savings account. If you put $100,000 in a high-yield savings account and it earns $5,000 in interest, the bank reports that to the IRS immediately. You owe taxes on that $5,000 next April. Why? Because interest is realized income. The government sees it. Appreciation, on the other hand, is tax-deferred magic. This is why the rich are obsessed with buying assets that do not pay dividends. If a company pays a dividend, that is a taxable event. The wealthy prefer companies like Berkshire Hathaway or early-stage tech stocks that reinvest all their profits to grow the stock price. They want their net worth to skyrocket on paper, while their taxable income stays near zero. Think about what this means. You could have a net worth of $100 million, but if you didn't sell anything this year, your tax return looks like you are unemployed. You are rich in assets, but poor in income. And being poor in income is the secret to paying zero taxes. But this leads to the obvious question that confuses everyone. Stiles, if I put all my money into stocks and never sell them, how do I eat? How do I buy the mansion? How do I pay for the private jet if my bank account is empty? You can't pay for groceries with a stock certificate. You need cash. But selling your stock to get cash triggers a tax bill. This is where Phase 2 comes in, and this is the part that feels like a cheat code. Phase 2 is borrow. You need to memorize this sentence. Debt is not taxable. If your employer gives you $1 million, the IRS takes 40%. If a bank lends you $1 million, the IRS takes 0%. In fact, not only is the loan tax-free, but you get to keep your assets growing in the background. The wealthy use financial tools called securities-based lines of credit. They walk into a private bank, like JP Morgan or Goldman Sachs, and say, "I have $50 million in this portfolio. I don't want to sell it. Instead, I want to use it as collateral for a loan." The bank looks at the portfolio, sees it is stable, and says, "Okay, we will give you a revolving line of credit for $2 million cash." The wealthy person takes that $2 million and spends it. They buy the cars, they pay for the vacations, they live their life. Now, you might be thinking, but what about the interest? Isn't debt expensive? For you, yes. For them, no. When you have millions in collateral, you get access to interest rates that normal people never see. We are talking about rates that are barely above the bank's own borrowing costs. Let's do the brutal math. If their $50 million portfolio grows by 8% this year, they made $4 million in gains. If they borrowed $2 million at 4% interest, they paid $80,000 in interest. They made $4 million. They paid $80,000. They are essentially getting paid to borrow money. They get the liquidity they need to live lavishly. They pay zero taxes because it's a loan, and their net worth still goes up because the asset growth outpaces the interest rate. Warning: do not try this with a credit card. Borrowing at 22% interest to buy a TV is poverty. Borrowing at 4% interest against an asset growing at 8% is leverage. One destroys wealth, the other creates infinite liquidity. Do not confuse the two. So, you buy assets. You borrow against them to live. But, eventually, the bill comes due, right? You can't stay in debt forever. Eventually, you have to sell the stock to pay back the bank, which triggers the taxes you were trying to avoid. Unless you execute Phase 3. Phase 3 is die. I know it sounds morbid, but death is the ultimate tax strategy in the United States Code. There is a specific loophole called the stepped-up basis. Here is how it works. Let's say you bought Apple stock in 1980 for $100,000. Today, it is worth $10 million. If you sell it while you are alive, you have a $9.9 million profit. You would owe the IRS roughly $2 million in capital gains taxes. But if you die while owning that stock, a miracle happens. The IRS steps up the value of the stock to the price it was on the day you died. They treat your heirs as if they bought the stock for $10 million. All the gains that happened during your lifetime, the $9.9 million in profit, deleted, wiped from the record. Your heirs inherit the stock tax-free. They can turn around and sell it the very next day for $10 million, and they will owe zero taxes. They take that tax-free cash, pay off the loans you took out to live on during your life, and keep the difference. The government gets nothing. The cycle of wealth transfers to the next generation unbroken. That is buy, borrow, die. Okay. That is how the billionaires do it. But you don't have a $50 million portfolio to borrow against, and JP Morgan isn't offering you a 3% interest rate. So, does this mean you are stuck paying 30% taxes forever? Number. You can replicate the buy, borrow, die framework using standard accounts available to regular employees. We call this the tax triad. Level 1 is the 401k match, the free lunch. Before you worry about advanced strategies, you have to take the free money. If your employer offers a match, that is a guaranteed 100% return on your investment. It also lowers your taxable income today. If you make $80,000 and put $5,000 in your 401k, the IRS only taxes you as if you made $75,000. This is the only time in life someone will pay you to save your own money. Take it. Level 2 is the HSA, the Swiss Army knife. Most people think the health savings account is just for buying Tylenol. They are wrong. It is the most powerful investment vehicle in the tax code. It is the only account with a triple tax advantage. 1. You get a tax deduction when you put money in, just like a 401k. 2. It grows tax-free, just like a Roth. 3. If you use it for medical expenses, you pull it out tax-free. But here is the rich person hack for the HSA. Don't use it for medical expenses now. If you go to the doctor and owe $100, pay it with cash from your pocket. Keep the receipt. Let your HSA money stay invested in the S&P 500 for 30 years. Let it grow to $500,000. Then, 30 years later, present that receipt to yourself and reimburse yourself tax-free. You just created a tax-free investment account that acts like a supercharged retirement fund. Level 3 is the Roth IRA, the harvest strategy. With a Roth IRA, you pay taxes on the money now. You bite the bullet today. But once the money is in the account, the IRS can never touch it again. Think of it like farming. With a 401k, you don't pay taxes on the seed, but you pay taxes on the harvest. With a Roth, you pay taxes on the tiny seed, but the entire harvest, the millions of dollars of growth, is 100% tax-free. If you invest $10,000 in a Roth and it grows to $1 million over your lifetime, you paid taxes on the $10,000. The $990,000 of growth is free. This is your version of buy, borrow, die. You are opting out of the tax system for your future self. Here is the brutal truth. The government needs tax revenue. And since they cannot effectively tax the wealth of the rich because of the buy, borrow, die strategy, and they cannot tax the poor because they have no money, they rely on the middle class and high-income earners to foot the bill. If you are relying solely on a W-2 salary, you are the target. Here is your deliverable. Stop focusing entirely on earning more income. Income is inefficient. Start focusing on owning more assets. Fill your 401k to the match. Max out your HSA. Max out your Roth IRA. Move your money from the high tax bucket to the zero tax bucket as fast as possible. The rich aren't smarter than you. They just have a better rulebook. Now you have it too. Start owning. If you want to know the exact mathematical order to fill these accounts, should you do the HSA before the Roth? I break that down in the next video. I'm Stiles. Don't pay more than your fair share. Make sure to subscribe, and I'll see you in the next one.